Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Turning back to the Federal Reserve, sources telling us, our colleagues here at Bloomberg, that a driving force behind the DOJ's decision to subpoena the central bank is the Federal Housing Finance Agency Director, Bill Pulte. Director Pulte's been busy over the last week. Some purchases of MBS in focus as well. Director Pulte, welcome to the programme, sir. You are cited in our story this morning. Just wanted to give the opportunity to respond to it. Bill, what was your role in the developments over the weekend?
The DOJ is outside of my purview. This is out of my purview. I don't know anything about it, and I would defer you to the DOJ.
Bill, you haven't been shy of sharing your thoughts on the Federal Reserve before, particularly over the last 12 months. You thought that the chairman would ultimately resign. He's standing firm. Do you think this push against the Federal Reserve is actually leading to unintended consequences and leading this Fed to dig in?
My main focus, John, has been on reducing mortgage rates to the extent that we can do it and increasing housing affordability. President Trump announced a huge thing last week when he decided that he was going to ban institutions from buying homes. Basically, the concept is that people should be living in homes, not corporations. You know, we have a supply problem in this country, and obviously we're working on the demand side of things because in some cases, affordability has gotten so tough that people don't even want to buy a home because of what Joe Biden did. And so we're reversing that. That's what we're focused on. We had a huge 1-2 punch last week. You saw mortgage rates move 25 basis points lower on the news that Fannie and Freddie have started to undergo a $200 billion mortgage bond buy. And I think you're going to see some very exciting things come out of Davos with regard to the president on housing in a week.
Director Pulte, you were with the president this weekend, I believe, traveling with him on Air Force One from Washington to Palm Beach. Did you talk about the Federal Reserve with him this weekend?
Obviously, I would never talk about anything that the president and I talk about. I would say this, that the president is laser focused on housing affordability and reversing what has happened these last 4 years. You look at the average mortgage payment under Joe Biden, it's skyrocketed compared to what it was under President Trump's first term. We are focused on bringing down not only the mortgage rates, but also the day-to-day cost in upkeeping homes, which has to do with, whether it be your ongoing expenses, mortgage insurance, et cetera. There are so many pieces to the cost puzzle that at the FHFA, U.S. Federal Housing, we are working to reduce the cost burden that Americans have.
I know that you've seen the report from our colleagues. I've also got calls last night about this subpoena handed to the Fed and was told that you were part of it, pulling together a report that then went to the DOJ. I just wanted to go a sense from you. Did the president know this was coming? The Treasury Secretary know this was coming? Have you had any of these conversations?
Again, on that matter, I'd refer you to the Department of Justice.
Okay, well, we'll wait to hear from the Department of Justice. When it goes back to the mortgage-backed securities that you have been talking about, you've already been purchasing about north of $230 billion of them last year. There is a cap. Do you expect to reach that cap this year?
I think all options are on the table. President Trump is a president who keeps all options on the table. We announced this historic $200 billion buyback of mortgage bonds. This is a huge deal. And, we'll keep all options on the table. Look, we're doing our part at Fannie and Freddie. Most presidents didn't even know Fannie and Freddie existed. Obviously, your community and Bloomberg and all of us in the private sector, we know the importance of Fannie and Freddie. But for the average day American, they don't understand because the presidents haven't made it a priority. The average Americans haven't understood that presidents had this authority until President Trump found this authority, which is basically to utilize these companies to be companies. Imagine that. Get people to show up back to work. We had 16,000 people. We have 16,000 people at the two companies. When I showed up on the scene and President Trump came into office, they were all working from home. We'd go to these big buildings, air conditioning spewing everywhere, spending $50 million a year on leases. Nobody was in these buildings. So we have turned around Fannie and Freddie. They tried to get President Trump to sell the companies the two companies together for $100 billion. I think the valuation of the companies is anywhere between $500 billion and some say up to $1 trillion.
A lot of people are hoping that there is some sort of initial public offering of those companies. Are you preparing them for that at some point later this year or next year?
We are fully prepared to do whatever the president would like us to do on that matter. We have been getting prepared. We are prepared just like we are with the institutional home buying ban, just like we are with home builders. We have a full set of things to do. And once the president decides what to do, we go about executing them.
Director Pulte, a lot of people on Wall Street were pretty excited, actually, about your purchases of MBS, of mortgage-backed securities, and saying that this seems like it should be something that would bring down spreads. They were less excited about the idea of preventing institutions from buying single-family homes, saying that it really wasn't based in economics, considering that in certain regions in the country, there's actually a glut of houses, that this is not because of institutions that account for a relatively small portion of overall buyers. What do you say back about the economic fundamentals behind this type of proposal and why it would bring down affordability and increase the supply of houses, which is the ultimate issue that a lot of people say?
Well, it just makes economic sense. You talk about supply. I mean, you kind of gave me a narrative there, but if you look at the economic supply of things, the fact is you have, big corporations buying, using long-term paper, using their balance sheets to scoop up homes in a supply shortage, as we call it. And they're in some cases buying these homes for 20, 30, 40% less than Americans are doing it. President Trump was elected with a very, very popular mandate. Sometimes people don't remember because it was a year ago, but it was a landslide victory. And he was given a mandate to reverse these last 4 years of crazy inflation that happened under Joe Biden. And so I think it's very appropriate that we're doing everything that we can to reduce housing costs. And we're going to keep doing it, whether it's the institutional ban on buying, looking at all of the things that go into a home and owning a home. Americans need to own homes in this country, and we're committed to restoring that.
Director Pulte, did you study this in terms of the supply-demand dynamic and whether it actually would reduce the cost of houses for individuals? Should there be a ban on single-family housing, on institutions buying single-family homes? Because a lot of people in the markets who have supported President Trump's policies, I'm thinking of Neil Dutta in particular, came out and said, this is faulty economics.
Well, of course I've studied it. I've studied it my whole life. I mean, I grew up in the housing business. I grew up in the building business. I was on the board of Pulte Homes for 4 years. I understand what institutional buying does. It's very powerful. I understand why Wall Street might not like it. But we serve the American people. We don't serve Wall Street. And President Trump is laser focused on doing the right thing, no matter who it affects in terms of their pocketbooks at the Wall Street level. He is laser focused on action, not talk, like so many of these Democrats, like Elizabeth Warren. For years, she would talk about, institutional buying. She didn't do anything. Joe Biden didn't do anything about it. President Trump is doing something about it.
Elizabeth Warren wanted to see an effort like this. Do you think the president is taking cues from some of the more populist wings of the Democratic Party?
No, I think Elizabeth Warren's going to have to take cues from us, or she's going to continue to look like a fraud, because she says all these things and then she does nothing about it. President Trump, he gets things done. He said, look, we're going to ban institutional buying. And then we're going about both on an executive action front as well as codifying it in legislation. I mean, the amount of momentum that we've had at the legislative level from, different Congress people. I was at the Financial Services Committee the other night. People were ecstatic about this. I also talked with multiple U.S. senators, many who are vying to sponsor the legislation. So this is a very big deal, and I think it's going to happen.
Is the president going to declare a housing emergency in the United States?
That's entirely up to the president. I can tell you this, he is treating it with great urgency. He understands real estate very well. He understands the importance of keeping home prices up. He understands this issue very well, and we're working very well together. Secretary Turner, Secretary Bessent, Secretary Lutnick, the Vice President, Susie Wiles. This is an all-hands effort. James Blair in the White House. I mean, this is an all-hands effort to reduce the cost of home ownership and get people, not corporations, back in homes.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the Middle East. Iranian officials saying they've secured full control over the country after mass protests led to 2 weeks of upheaval and hundreds reported killed. President Trump set for a key briefing on potential U.S. involvement as soon as tomorrow. Joining us now is former senior U.S. intelligence official Norman Roule. Norman, welcome to the program, sir. We've seen this in this country many times over the last 10 years. This felt different over the last week. How different is it?
It's quite different. And good morning. The current nationwide protests in Iran continue to have reached a scale and intensity that is unprecedented in the history of the Islamic Republic. Virtually every major city and town is experiencing some form of political protest against the government, calling for regime change, not just complaints against a specific economic policy. And what you have is the tactical government efforts to contain these protests through promises of economic reform have not satisfied the protesters, and increasingly coercive and violent responses by the government have not ended the protests thus far. And the result is that we've seen deaths. We've seen hundreds of protester deaths. We've seen as many as 40 to 50 to 100 security force personnel be killed, and we've seen thousands of arrests. So we're watching a very intensive, turbulent situation in Iran.
Norm, absolutely horrific, these images coming out of Iran. What makes this protest, though, different than prior protests we saw?
We're watching basically a very compressed situation. So in the 2022 to 2023 situation, for example, the number of the tragic number of deaths, for example, that took place over a much longer period of time. The number of arrests took place over a much longer period of time. So we're watching a compression of this. And this is happening because the inflation, the collapse of the currency, the disillusion with the government, the failed policy, the oppression, it's built upon itself since 2017. So you've got an extraordinarily unhappy population that feels the government, correctly so, feeling that the government is just unable to deliver. And at the same time, you have a government that is broken. It's trying to satisfy a military that's taking a large portion of the budget, missiles, regional militias, a nuclear program that's brought sanctions upon the government, while at the same time trying to promise economic relief to a population. And in the end, it can't deliver. And just the currency problem alone is extraordinary. So when at the time of the nuclear deal, the Iranian rial was 29,500 to the dollar. When the recently fired central bank governor took office, it was about 920,000 to the dollar. In December, when the protests began, it was 1.42 million to the dollar. There's no reason to believe that this collapse will not continue further because the government is broken.
Norman, overnight, Iran's foreign ministry said that there is a communication channel between their foreign minister and Mr. Witkoff now open. The president told reporters that the Iranian leaders have reached out. He also went on to say a meeting is being set up, but we may have to act because of what's happening before the meeting. How should we read the president's comments?
Seriously. So let's take a look first at what is the likelihood that the president will conduct a military strike. If you look at U.S. Behavior and the president's actions, there is a high likelihood of a military strike. The president has conducted surgical, limited military action following a series of social media statements, a series of promises of action if specific behavior is not undertaken, diplomatic outreach, and military moves. A lot of this has happened thus far. And the social media and the intensity of the president's social media statements have increased. We've seen a visit of the Omani foreign minister to Iran, which looked like a message one way or the other. Now, we have the Iranian outreach. So why is that happening? Well, that offers the Iranians several advantages. First, gives them a chance to tell their own population maybe sanctions are being lifted. So that might break the unrest. Unlikely. But it also might allow the United States delay the United States attack. I don't think that's going to buy them much patience with the president.
Norm, what could the U.S. do with respect to military strikes that would be effective? I mean, how risky is this at a time where already there is an incredibly explosive feeling in the region and previous incursions have led to mixed results?
Frankly, I think it'd be unwise to give a lot of detail because the Iranians are going to be interested in that question as well. But U.S. military power is vast. The Iranians have no capability to really defend against it, as we've seen in June. The press reports have talked about aerial attacks. Other tools are available, and the Iranians are very susceptible to this. The U.S. has the means to deliver an extraordinary punishing blow against those units and personnel that would be involved in violence against protesters. And that's what the president has talked about, responding to those who have committed violence and against peaceful protesters, deaths against peaceful protesters. And we've seen an extraordinary number of deaths in the last weekend.
Norman, we already have Venezuela with questions around who's going to lead it. If there is some sort of strike that does imperil the Iranian leadership, do we have a sense of who is going to take over and how intimately involved the U.S. will be with that?
I've been working the Middle East and other issues too long to make predictions on who will lead governments in the future, predicting elections. The Iranian people will no doubt choose their own leadership. I would say that there is a deep Revolutionary Guard network within the country, in corporations and all aspects of the leadership. If you were to draw upon the existing system of society, of who might follow, if the existing system remains in place, it's probably going to be drawn from that DNA. And that's the sort of DNA that would likely be willing to engage with the West and with the region in an assertive manner, protecting Iranian equities, but it would engage with the West.
Stay with us. More Bloomberg surveillance coming up after this. Torsten Slok of Apollo writes the following. The market reaction this morning is very muted, which is telling investors that the key issue continues to be the incoming data. Torsten joins us now for more. Torsten, good morning.
Morning.
Nice try. Still going to ask you about this. Tell me your thoughts this morning and your response to what took place yesterday evening.
I do think the market reaction is absolutely critical, especially the market reaction in long rates, the dollar, and also inflation expectations. And on all three fronts, we've had a relatively muted reaction. So one conclusion is that the market obviously is looking at this, and the reaction has been, as you would have expected, that rates are up a bit, the dollar is down. We'll see inflation expectations if they go up a bit more throughout the day, but it's still relatively small compared to how much drama has been made of this over the last 24 hours.
Is that a huge buy signal? Essentially, that this is a market that really believes in the institution of the Federal Reserve in the United States, checks and balances in a way that encourages you to invest in the United States?
Because investors come to the U.S. for two reasons. They come for AI and they come for higher yield. And when they come for higher yield, of course, it's because the rest of the world doesn't have great growth at the moment. And the level of yields for the Fed is, of course, higher than what it is for the ECB and for a number of central banks around the world. So for that reason, foreigners come to clip a higher coupon in bonds, and foreigners also come to get AI exposure. So for that reason, this is not directly linked as such to the AI story, but what this could be linked to is, of course, the yield story. If you begin to see the Fed lower interest rates, not for economic reasons, then the big question becomes, well, what would that mean for the steepness of the yield curve? Where is it foreign investors are investing? And if foreign investors are further out, then the risk is, of course, that the yield curve will be even steeper, and therefore foreigners will be getting an even higher level of yield further out the curve. So there's a lot of issues around this question of why is the dollar not weaker, namely because foreigners actually still like the AI story and they still like the higher coupon that they get in the U.S.
What would you have to see to suggest that the Sell America trade truly is starting to take off, that people are starting to take this seriously?
The dollar going down. Because that, of course, is ultimately the risk that foreigners will begin to say, well, we have less appetite for buying U.S. assets. But the key issue continues to be that the U.S. growth outlook continues to be much better than the growth outlook in Europe, much better than the growth outlook in Canada, Australia, Japan, because we have the AI data center boom and energy boom, of course, expanding everything over the next several quarters. We have the one big beautiful bill. We also have oil prices lower. We also have the dollar now marginally lower. All those tailwinds continue to support GDP growth throughout this year. Let's not forget that the one big beautiful bill is going to add 0.9% to GDP growth, according to the Congressional Budget Office in 2026. That's a very meaningful boost to GDP over the coming quarter. So that's why the consensus expects, if I look at ECFCGO and my Bloomberg, that the unemployment rate will peak just about now, and the unemployment rate is about to go down over the coming quarter. So that's a very important point when you think about the backdrop for this story about what's going on with the Federal Reserve these days.
When it comes to Sell America, what about, instead of the dollar depreciating, what about the fact that gold continues to hit new record highs? rise almost on a daily basis.
I do think that this is also a reflection of a broader thing, namely that there's also the issue, of course, that central banks that are imposed with sanctions are now shifting away from dollars towards gold. You also have that many Chinese investors have been buying gold. They've been buying ETFs in China in a very significant way over the last several quarters that we haven't seen before. So retail demand is very strong, and you also have, because of sanctions, very strong demand. And of course, inflation in the US, let's not forget, which we normally, of course, talk about, is that it is still not at 2%. It's still closer to 3 than it is to 2. And that, of course, is the number one issue driving gold most frequently, namely that if inflation is higher for longer, and we have an economy that's about to get better because of the one big beautiful bill, the AI and data center spend, well, that raises the risk that there's also more upside risk to inflation over the next several months.
Torsten, GDP right now is tracking at what, 4 to 5%?
Well, the Atlanta Fed GDP now, as you know, is very, very high.
Pretty fantastic, and the last read we had was pretty decent too. 4 to 5%, and the president's going after the Federal Reserve. The president's looking to cap interest rates of credit card companies. The president's going after things that are on the one hand are hurting home builders, on the other hand might help them. These are things we typically associated with GDP tracking closer to 1 or maybe in negative territory. What's gone wrong?
Well, I think a very important part of this discussion is that equity investors care about corporate earnings. And the last few earnings seasons have actually been pretty good. And corporate earnings still look pretty good if you look ahead. Consensus expectations are that earnings throughout this year will continue to rise. So if corporate earnings are still good, well, then equities likely say, you know what, if earnings are still good and these things are not impacting the bottom line, well, then we should still, of course, expect that equities could continue to do well.
That's Wall Street. What's gone wrong for Main Street?
Well, credit and bond investors, of course, have a lot of these things suddenly because this begins to matter in a number of different ways, especially, of course, when it comes to rates. So that's why it's more the bond market that's paying more attention to these risks. But even the bond market, the reaction today has had a very, very muted reaction. So that's why the conclusion here is as long as bond markets and the credit markets continue to view this from a relatively complacent and benign perspective, then we should still be looking at this from the fundamental perspective.
Can we just park markets for a moment? Just throw markets over there. I just want to talk about the fact that we're generating 4 to 5% GDP growth, and yet everyone seems to be terribly unhappy. What is so bad about this kind of growth? What is the character of this GDP growth compared to what it used to be like? The jobless growth this time around, what has changed? What has gone wrong with the growth that we're producing?
Yeah, so the key issue to that is, of course, is a K-shaped outlook both for consumers. We have high-end versus low-end, and we also have for corporates, are you in AR or are you not in AI? Those differences continue to drive that high-end consumer spend continues to be strong, and AI, of course, data center energy build-out continues to be strong. Those things dominate the negative effects that might be coming from the lower leg of the K. And the labor market is really mainly a reflection of immigration. Remember, in the last several years, 2022 to 24, net immigration was about 3 million. The Congressional Budget Office is now predicting will be about 500,000. That's why the Federal Reserve produces a lot of papers saying that the equilibrium rate for non-farm payrolls is no longer 200,000 like it was for several years. Now it's 30,000. So that's why last Friday's number on non-farm payrolls is actually a pretty good number when you take that into account, that we actually have had such a dramatic decline.
So we should be happy with 50K.
Yeah, so 50K is actually better than this St. Louis estimate of equilibrium for non-farm payrolls, which is 30,000.
Again, so why is everyone so miserable?
Well, the stock market doesn't seem too miserable.
Forget those people in the stock market.
Understood. So, but this is right. If you think about, of course, consumer sentiment, that's also been driven very differently according to where people are in the income distribution. But overall, it's still very clear that the economy is actually still in decent shape. And if you now have the tailwinds coming from the one big beautiful bill, again, 1% according to the CBO in growth being added this year, you still have data center spend out, and you still have also, of course, everything going on with lower dollar, lower oil prices. All that are really strong tailwinds to the growth outlook for the next several quarters.
Do American people feel the same way? Because the president's clearly responding to something. When he goes to Davos, Switzerland in a week and talks about this great affordability push, obviously he doesn't believe that the consumers in America see things the same way.
Well, of course, affordability is a little bit different discussion because it is correct that on a number of different fronts, of course, home prices have not done particularly well. There's also, of course, other areas with tuition, healthcare, etc., where the discussion has been very important. But nevertheless, the wealth effect for consumers has been strong. Job growth has still been relatively decent. At the same time, you now actually saw wages go up on Friday. You still have a number of tailwinds that mean that on average, the U.S. consumer, the weekly data from Redbook, same-store retail sales, impressively strong, still telling you that in aggregate, the net effect of the K is still that the higher end of the K is dominating the overall picture for where the macro data is.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.